Stock market's falling. News headlines say we're headed for a recession. Interest rates are rising. There's war and a crash is coming. You're probably wondering, what should you be doing with your investments? And I can't give anybody financial advice. I can't tell anybody what to do. But what I can do is share what I'm doing with my portfolio of my own money that I'm trying to grow from $10,000 to $1 million over the next 10 years. Just look at CNBC. The Dow is down 900 points. It plunges for its worst day since 2020 when COVID happened. S&P 500 is down 2.7%. The NASDAQ is down 2.5%. And the Russell 2000 is down 2.6%. The VIX, the volatility index, is up 23%. So what is happening? Nobody knows. This is the big secret. Nobody knows exactly why the stock market is going to fall or has fallen until it's already happened, and then they try to justify it and reason with it. Somebody will always have been right and been out there and predicted it, and you're going to see that headline and you're going to see that person in the news the next time something happens as the expert that predicted the '08 and '09 great financial crisis. What you're not seeing is the thousands or hundreds of thousands of people that made these predictions 10 times before and they were all wrong. The financial media, the professional investing realm is incentivized around transactions, around taking fees, around selling news headlines and getting views and getting clicks. That's not in the best interest of me as an individual investor. And so I invest with that in mind. And the way I invest is based off the best thing I know from history. This is the S&P 500, and this crazy looking chart is the percentage off highs. This goes all the way back to 1950. This line right here is a 20% drop, and we're using Y charts right here, which is a product that I love. The S&P 500 has dropped 20% since 1950, 12 times. At least 3 times it's dropped 40% or more. That's terrifying. That probably makes people never want to invest. But let's turn this around and let's look at the growth of $10,000 since 1950. If somebody had invested $10,000 into the S&P 500, which we all have access to that index from Vanguard, we can get those ETFs or index funds. In our 401ks, we could get access to those very easily for very low fees. Somebody would have invested $10,000 in 1950 and just left it there. It's worth $2.56 million. And that's through all of the pain, all of these drops, the 1999 bubble, the '08, '09 great financial crisis, through all of that. If we had the behavior and we had the strategy and the plan in place to invest monthly, or at least try to live below our means, save. Yes, things are going to happen. There's going to be times when we can't invest. But if we had that mindset and we were living within our means and had that lifestyle and could leave that money alone, it's life-changing. This is Apple since 1981. You might not be able to see this text, but it's up 165,000% since 1981. Again, turning $10,000 into $16.59 million. You may not invest in Apple in 1984 or in a company that does as well as Apple. Even if somebody invested $10,000 in Apple in 2011, over the next 11 years, that $10,000 has turned into $168,000. When I see all this fearsome headlines, I'm not predicting what's going to happen with the economy. I'm not saying nothing scary is going to happen. I don't know what's going to happen, but I just know over the last 50 and 70 years in the S&P 500, and then any long period of time in great companies, investors with a long-term mindset tend to do just fine. Here's an update on the portfolio. I'm not selling anything. This portfolio started February 15th, and we're down 15% already. I could care less if I'm down 15% in a month because, again, I'm after that long-term time horizon. Horrible investing, Austin. You should just wrap it in and quit. That's exactly the feeling you have at this time, but it's the opposite, in my experience, of what we should actually be doing. Here's a look at the positions in the growth portfolio. This isn't going to be a full review. Everybody do their own research, but I'm just sharing transparently my largest to smallest position, the sizes, and then we'll jump into fast graphs and I'll show what I think some of the opportunity in these companies are based off their current multiples and valuation after this. So we've got Tesla, number one in the growth side at about a $1,500 position. GitLab, another almost $1,500 position. Amazon, right up there, about $1,500. CrowdStrike, around $1,400. Snowflake, $1,300. Monday.com, $1,200. Twilio, about $1,000. Mercado Libre, right around $900. Salesforce, right around $800. ServiceNow, $768. Shopify, $615. The Trade Desk, $573. Upstart, $565. Datadog, $489. Coinbase, $445. Zoom, $438. And Bill.com, $413. Dividend growers: Lowe's, Advance Auto, American Tower, MasterCard, Amgen, Broadcom, 3M, AbbVie, Fidelity National, and Raytheon. All about the same size, other than Lowe's. I just thought the opportunity was really great in Lowe's, $1,700 position, and Advance Auto is an $800 position. Everything else is right around $300. Crypto bucket, nothing crazy to share here. It's just ETHE and GBTC, 50-50 in this side. I just think, crypto's here to stay, and I think Ethereum and Bitcoin will do just fine over time. And so that's the exposure I have in this portfolio. Again, not saying this is the best way to invest in crypto, but as a public market portfolio, it's a decent way to get some exposure to the potential upside of crypto without the risk of losing wallets and all this other, these other things that can happen if you're deeper in the crypto space. And what I want to mention here is that my portfolio is connected on commonstock.com. That's this platform right here. And it's a great place. You can see people's portfolio. There is research for free that people share all throughout here. There's all kinds of stock write-ups. And what I'm doing, I'll share this link in the video description. Click the link in the description that says join the 10K to $1 million club for free. It'll take you to this platform. You can sign up. If you join this group, you'll kind of join this little chat room that we have. I'm not going to spam you, I promise, but we can chat back and forth. And the cool thing is there's a leaderboard in here. So anybody that's in here and has their portfolio connected, we can just have some friendly competition and see how our portfolios are doing. That's not mandatory. People could do that if they want to. It's optional. Anyways, let's jump into fast graphs. I'm going to just run through these companies and why I think there's some good opportunities, especially after this sell-off. So a quick explainer on fast graphs. This orange line shows what fast graphs believes the fair value is based on the current valuation metric we're using. The blue line is the company's actual average valuation over the time period we're looking at. The black line right here represents the price of the stock. Everything to the left here is actual numbers that they've actually had, and everything to the right is projected based off what Wall Street analysts project is going to happen. This doesn't predict anything, but it shows what the results could be if expectations are met. These green dots, you can see where I've bought at. Right now with Amazon, I think a good way to look at the business is operating cash flow. We could see since 2010, Amazon has grown its operating cash flow at 27%. So that means this orange line is a price to operating cash flow of 27, and its average that it's actually traded at on average has been around 25, so almost together. So what I can do is I could take this dot from yesterday's price, so it's even lower today, take it out to what analysts expect the operating cash flow to be in 2024. If it stays at a price to operating cash flow ratio of 25.4, we would be looking at a 36% annualized return for a 129% return. And if we go to forecast, they're expected to grow operating cash flow at 27% over the next several years. And if we remember, that's right in average with where it's grown historically over the last since 2010. So I think there's a real chance it deserves to trade somewhere around there over the next few years. Even if it trades down to 18, you're looking at a 22% annualized return. Even if it trades down to 13, you're looking at a 7% annualized return. Okay, CrowdStrike was the second large position that I'm really going to be focused on adding to over time. You can see my buy, I bought it at a price to sales ratio of 32, which sounds insane. But when the company's been growing sales at 80%, 78%, 59%, and they're expected to continue growing revenue per share at 46% and 35% for the next 2 years. Right now, it's trading at a blended price sales ratio of 29. If we go to forecast, we can even that out a little bit. And even if we take that to down to a price to sales ratio of 18 in 2025, based off current expectations, we're looking at a 12% annualized return. That's a significant drop from 29 to 18 price sales ratio. You're still looking at a almost 12% annualized return. GitLab was the third company that's a large target position size that we will likely keep adding to with new money. And so you can see my buys. I bought at 38, bought again around 39, bought at 49 for an average cost of 39.88. It's currently trading at 48, so we're still up on that. This is a new company, has not been public for very long, but it's currently trading at a blended price to sales ratio of 25, and they're expected to grow revenue per share at 53%, 39%, and 36% for the next few years. And so again, with GitLab, if we take that out to a price to sales ratio of 18, while they're still growing, 35 to 40%, we're looking at an annualized rate of return of 26% for a total return of 92% through January 2025. Snowflake is another one. We've bought this one a bunch just with buys coming in because I'm very bullish on how important this company is going to be to every company that interacts with data, which is really every company in the future. So my average cost is $218.73. We're clearly well below that. You can see where I bought. I bought at a price sales ratio of 62, 45, 41, 52, and 42. Right now, it's trading at a blended price to sales ratio of 37 with expected revenue per share growth of 67%, 54%, 52%, 50, 33, and 31%. And so if you take that out and you take that from here, and we got to have a long-term time horizon, but if we take it from 2022 to 2028, which is a long time, but even with growth slowing down to that 30% per year, which is basically expected, and the price to sales ratio dropping from 37 to 15, so more than a 50% reduction in price to sales, you're looking at an annualized return of 25% for a total rate of return of 260%. In order for me to think this way, it means I have to believe that their platform has staying power, they're going to continue to innovate, they're going to be able to fend off competition, and I fundamentally believe that everything we've seen from the company tells us that they're on that track right now. That's from triple-digit revenue growth, their remaining performance obligation, that's how much they've essentially pre-booked that growth, and then their net dollar expansion rate, which is around 180%. And for the size company that Snowflake is, there's no company in the world growing net dollar expansion rate that fast. That's how much their customers spend each year. So if it's 180%, that means from one year to the next, the same customer on average is spending 80% more. That means they're not having to market and get that new customer again. And that shows that their platform is useful and people are spending more money on it over time. I'm not going to invest in this and never look at it again but I'm going to pay attention to, are those business fundamentals continuing to track towards the company's long-term plan, which they've provided? If it does, then we're still on track and I feel good. If it doesn't and they show quarters of weakness and we get off track and there's no fix in sight, then I would consider selling my position. But if things are on track and things track well and I can stay focused and keep this long-term plan, there's a huge opportunity for a company like Snowflake, even with how expensive it is from a price to sales multiple basis. Tesla is another one. I've talked about this in previous videos, so check those videos out. Just search Tesla on this channel and you'll see the thoughts. Kathy Wood's out there with a $5,800 price target in, I think, 2026 or something like that. Worm Capital said they think it could 10x by 2030. Those would be amazing. I'm not banking on that happening. Here's where I bought it at a price sales of 17 and a share price of 981. So it's a little bit higher than that, or at least yesterday it was. It might be lower today. So we jumped to forecasting. This is price to sales, which isn't a perfect metric for Tesla, but for high level, we could talk about it that way. It's okay. Worm Capital in their 90-page deck expected them to grow revenue 50%, a 50% CAGR. Compound annual growth rate, and I think through 2030. So we went to long-term growth. We're using this. These are NA, but the point is it's using 40%, which is lower than theirs. Still really high. I don't know if it's going to happen, but right now it's trading at a price sales of 18.8. So, if they hit this growth rate, which I think is possible, it's probably unlikely, but everything Tesla's done so far has been unlikely, and it trades down to a price of sales of 5, you're still looking at 11% annualized return. And then, if it's trading at a price of sales of 10, which if they're executing at that level, margins are improving, I don't think it's out of the realm of possibility for it to trade at a price to sales ratio of 10 at that time. If it trades at that and they hit these revenue numbers, then the annualized rate of return is 25%. And we're still, well below what Worm Capital's expected return is. But I'm not banking on that return and the reason that I'm invested in Tesla. I'm banking on something more conservative, and if you get more upside, great. Hey, thanks for watching. I know it's scary out there. The headlines are freaking us all out. In my experience, this is the time, if we can be, to be long-term investors. Buy great businesses that have products that matter, have a process and a mindset to keep investing. If you want to join a thoughtful group, make sure to click the link to join the 10K to 1 million club for free on Common Stock. Join the chat. We can talk back and forth. We'll have a friendly competition with the leaderboard. And if you have a company that you want me to review, I'm going to do subscriber request reviews next week. So leave it in the comments and I will review whatever company you ask me to in the comments. Love it if you like this video. That tells me make more of these, you like these, and subscribe to the channel so you never miss an update. Take care of your mind, your body, and your money. Have a great weekend, and remember, there's more to life than just investing. Investing is supposed to complement our lives, not consume our lives.